Good morning, and welcome to the Bulls, Bears, and the Bell Morning Edition. Thanks so much for joining us. We are strapping in today for a deep dive into a financial landscape that isn't just sending mixed signals. It feels profoundly, maybe even fundamentally conflicted. Our mission today really is to give you a clear, actionable handle on the pre-open environment for October 8th, because the market right now is defined by this massive clash, a zero-sum battle almost, between two really powerful opposing forces. On one side, you've got that soaring, high-flying, micro-level optimism around the artificial intelligence investment cycle. That's the bull, the relentless one we've watched all year. But then on the other side, there's this deep, almost existential fear. It's driven by macroeconomic uncertainty, U.S. fiscal policy, well, brinkmanship, frankly, and systemic risk. That's our entrenched macro bear. So the whole session, especially until this afternoon, it really hinges on one big question. Which story wins today? Is it the micro bull betting on corporate innovation, or is it the macro bear betting on systemic instability? Which one's going to dominate trading?
And that tension is, well, it's palpable just looking at the early data. U.S. equity markets are trying for a rebound, but it's modest, almost apologetic, you could say. This comes after Tuesday snapped that pretty impressive 7-day winning streak we saw, mainly in tech. That halt was mostly down to semiconductor profit-taking. So as of the early hours, S&P 500 futures are only up slightly, maybe plus 0.14%. The tech-heavy NASDAQ 100 futures, they're leading, but only fractionally higher, around plus 0.19%. This feeling of, tentative stability, it's really deceptive. It's hiding this enormous psychological tension just beneath the surface of the indices. It indicates a market that's waiting, desperately waiting, I'd say, for some kind of definitive signal before committing capital one way or the other.
Okay, let's unpack that psychological tension right away, because tentative stability just doesn't quite capture the drama, does it? What we're seeing isn't really a balanced market. It feels more like a bifurcated market, split right down the middle, signaling totally contradictory bets on the future. I mean, how can we have tech indices ticking up, suggesting there's still appetite for risk and future growth, while at the exact same time, we see traditional, deep safe haven assets absolutely surging into historic territory, no less? That's the core contradiction today, isn't it?
It's a fascinating disconnect, absolutely. And it truly boils down to where major investors are placing their long-term faith, or maybe their bets. The bullish side, let's call it the micro bull, it's anchored firmly in this belief that the AI revolution is a bottom-up thing. A fundamental driver of corporate profit expansion that's just, well, too powerful to be derailed by short-term macro noise. And the evidence is right there, isn't it? The NASDAQ 100 futures leading the way this morning, up that plus 0.19%, even after the broad chip sector profit-taking we saw on Tuesday. So that tells us the money manager community, they still believe corporate cash flow growth, especially driven by AI, infrastructure build-out and adoption, will eventually override these current fiscal and geopolitical worries. It's a very specific bet, an aggressive one, really, on the future earnings of just a handful of revolutionary tech companies. They're essentially betting on innovation itself as the primary hedge against all this uncertainty.
Right, so that's the bull betting confidently on future corporate cash flow. But the macro bear is placing its chips somewhere much darker, systemic instability. And you can just see that fear reflected in how aggressive those safe haven moves are.
Exactly. The bearish narrative is just as powerful, and it's driven by these profound macroeconomic headwinds that feel structural, not just cyclical. You absolutely have to look at gold futures first. They are extending what's become a historic breakout. Gold is holding firm above that psychologically huge and technically critical $4,000 per ounce level. It's up a staggering 1.48% this morning, pushing past $4,060. Look, this isn't just normal market volatility. This is a clear, powerful signal of deep, deep anxiety. And this gold surge connects directly to what traders are calling the debasement trade. And this isn't really a bet on inflation in the traditional sense, it's more a strategic hedge. Investors are actively protecting themselves against these deep-seated worries about long-term U.S. fiscal policy. We're talking massive, sustained government deficits that, over time, well, they erode the purchasing power and the stability of the U.S. dollar. Historically, when investors lose faith in a country's fiscal discipline, the belief that the U.S. can actually sustain its debt without basically devaluing the dollar implicitly, capital just floods into physical assets, like gold.
This kind of capital flow is intensely defensive. It's systematic. It signals that a large, influential part of the market sees the global financial structure itself as inherently unstable, needing a physical, apolitical hedge.
And the bond market, the fixed income market, it's echoing that exact same anxiety, right? Confirming that defensive posture.
It is, yeah. We're seeing this continued, steady slide in the yield on the benchmark 10-year U.S. Treasury note. It's edging lower, down around 4.13%. This drop reflects two things happening at once. First, it definitely confirms that flight to safety dynamic. Investors are moving money into relative security of government bonds, even with low returns. They're prioritizing keeping their capital safe over getting big returns. Second, and this is crucial, it reflects positioning ahead of the FOMC minutes later today. Traders are anticipating, or at least pricing in the possibility of, a more dovish outcome from the Fed. That would cement lower rates for longer, which further supports this idea of a defensive, risk-averse market environment.
Okay, so domestically, it's AI bull versus the dollar debasement bear. But if we zoom out a bit, look at the global picture, it gets even more complicated, doesn't it? Asia was generally mixed or down. Hong Kong's tech sector had a notable sell-off, probably linked to the profit-taking we saw here. But then Japan's Nikkei Mento just absolutely surged to all-time highs. How do you square that with this global fear index going up?
Oh, that Japanese story is absolutely essential. It really highlights the extreme monetary policy divergence that's defining global capital flows right now. The surge in the Nikkei, yeah, it's partly supported by the Takaichi trade, linked to the new ruling party leader, Sani Takaichi. She's widely expected to push for more aggressive fiscal spending and maybe higher inflation targets. But the real structural driver, it's the weak yen. The Bank of Japan is sticking to its ultra-loose monetary policy, even while the rest of the world is tightening or pausing. This policy gap effectively acts like a massive subsidy for Japanese exporters. Companies like Toyota, Sony, they see their foreign earnings just skyrocket when they translate them back into cheap yen. This inflow of capital benefits their huge exporter base, and that's what drives the Nikkei to those all-time highs. It's a completely different engine than the U.S. market, which is reacting to geopolitical risk and this fiscal paralysis. It just shows that in today's world, specific monetary policy differences can totally shield an equity market from global macro fear. It's quite something.
Right. So connecting all these different threads, we basically have a high-stakes staring contest. One side is betting heavily on instability, fiscal irresponsibility, currency weakness. You see it in the gold surge, the low 10-year yield. The other side's betting on tech innovation, exponential growth, sustained corporate earnings. That's the tech futures ticking up. We're sitting at a genuine zero-sum duel here, where the market's direction for the whole day really hangs entirely on which of those two profoundly contradictory stories gains the upper hand.
Precisely. And the thing that's going to break this stalemate, the massive signal that forces the market to finally choose sides, it's sitting right there on the calendar at 2:00 p.m. Eastern Time.
Okay, let's shift focus to that pivotal event. The U.S. government shutdown, it's now entering its second week. And this prolonged situation has created what you could call a critical, maybe even toxic data vacuum. Key reports that normally drive market moves, like the CPI inflation numbers, the non-farm payrolls employment data, they're all delayed, postponed, or just plain missing. And when the market is flying blind like this, the importance of every scheduled release gets magnified exponentially.
That's the core thesis for today, really. The shutdown has basically elevated the 2:00 p.m. ET release of the September FOMC meeting minutes into the single most important catalyst for the entire trading day. The market desperately needs the Fed to fill that information gap. Now, to understand just how much weight these minutes carry, we have to remember the context of that September meeting. This was the one where the Fed enacted its first interest rate cut of 2025, right? A 25 basis point reduction. And while the cut itself passed with what looks like a lopsided 11-1 vote, the details behind that vote are incredibly telling. The lone dissenter, the newly confirmed governor Stephen Miran, he actually argued for a more aggressive 50 basis point cut. So that means the committee's internal debate wasn't really between cutting and holding steady. It was actually between cutting conservatively and cutting aggressively. That immediately signals a pretty strong internal debate about the speed, the necessity of easing policy.
Okay, so the market isn't just focused on the cut itself that's already baked in, presumably, but rather on this deeply divided committee and the underlying arguments that fueled that division.
Absolutely. We have to look back at the dot plot that came out after the meeting. It really laid bare the committee's split view looking forward. 10 out of the 19 senior Fed officials favored 2 additional rate cuts before year-end. But the other 9, they favored only 1 more cut, or maybe even none at all. That's a razor-thin margin, a highly contested vision for policy for the rest of 2025. So the market is going to scrutinize every single word in those minutes, the transcripts, the summaries of discussions, hunting for clues about the arguments behind those different views. We need to understand in detail how they weighed the risks. Risks to the labor market versus the persistence of inflation, which, let's remember, is still running close to 3%.
And here's where the massive risk factor comes in, right? Those minutes, they're based on data and a collective view from before the government shutdown even started. They reflect a pre-shutdown economic reality. But the actual economic reality might have changed significantly in the past 2 weeks, especially around consumer confidence, maybe supply chain stability.
That's the trader's paradox today. How the Fed's reaction function, their historical pattern and predicted way of interpreting limited or missing data, how that's described in the minutes, is absolutely critical. Traders are basically betting on the Fed's psychological bias. Are they inherently more worried about a potential recession? That's dovish. Or are they primarily worried about inflation sticking around? That's hawkish. The market is kind of forced to assume the minutes are still relevant, even if the underlying conditions might be stale. It makes this a really high-stakes, almost binary bet on the Fed's mindset.
Okay, let's get the listener ready for 2:00 p.m. ET. Let's lay out those two binary outcomes really clearly. What kind of language should they listen for, and what are the likely market reactions? Scenario 1, the dovish interpretation. This happens if the minutes show committee members expressed maybe greater anxiety about a potential weakening labor market, or if they explicitly downplayed the risks of inflation staying near 3%, perhaps dismissing it as just temporary friction from tariffs or something. That would be read as a green light for more aggressive easing down the road.
And the market mechanics would likely be swift, decisive. The U.S. dollar index, DXY, that basket, measuring the dollar against other currencies, our go-to gauge for global risk appetite, it would probably weaken significantly. Treasury yields would likely fall further from that 4.13% level. Now, why is this good for stocks? Well, when future yields fall, the present value calculation for future corporate earnings, especially for those long-duration, high-growth tech stocks, it increases dramatically. So risk assets, equities, but also precious metals like gold, they get massive coordinated tailwinds, could lead to a sharp afternoon surge.
Wait a second. If yields fall and the dollar weakens, shouldn't gold maybe pull back a bit? Lower rates often mean less urgent need for a hedge, right? Why would risk assets and precious metals surge together here? Isn't that kind of conflicting?
That is a brilliant question, actually. It really highlights the complexity we're dealing with right now. In a, let's say, normal market environment, you'd absolutely be right. But under this debasement trade thesis we talked about, gold's primary driver isn't just inflation expectations anymore. It's systemic fear related to currency stability and fiscal policy. So if the Fed confirms a dovish path, it signals they're prioritizing short-term economic support over maybe strict monetary discipline. That implicitly increases the long-term risk of dollar depreciation. And that's exactly why gold rises in this scenario. It's not acting like a traditional inflation hedge here. It's acting as a flight from sovereign risk. So yes, weirdly, both growth stocks boosted mechanically by lower yields and gold boosted structurally by the weaker dollar and dovish Fed could surge at the same time.
Okay, that distinction between the traditional inflation hedge and the systemic dollar hedge is really crucial to grasp. Got it. Let's look at the flip side then. Scenario 2. The hawkish interpretation. This scenario plays out if the minutes show substantial, maybe unexpected, worry about inflation staying stubbornly high. Or perhaps if committee members really emphasize the potential inflationary hit from recent trade tariffs or supply chain issues. This would be a genuine hawkish surprise for a market that seems to be pricing in continued cuts.
And the mechanics just reverse instantly. You'd likely see the U.S. dollar index, DXY, strengthen sharply. That signals a pullback in global risk appetite, a renewed belief in the dollar's relative strength. Treasury yields would likely rise sharply. The result? A significant sell-off, especially in those rate-sensitive growth stocks, the high-flying tech names whose valuations depend so heavily on low discount rates. And you'd likely see a retreat in gold, too, as its hedge status gets temporarily reduced by that stronger dollar. This scenario would dramatically empower the macro bear narrative we discussed. Now, beyond the main event, the FOMC minutes, we still have a couple of supporting data points that matter, especially given this heightened sensitivity to any real numbers. At 10:30 a.m. Eastern, we get the EIA crude oil inventories report. Consensus expects a build of about 2.25 million barrels. Since WTI crude is trading pretty strong above $62 a barrel, a price that definitely raises inflation eyebrows, this report is important not just for energy traders, but also for broader inflation expectations feeding into that Fed release. And then at 11:00 a.m. Eastern, we get the MBA mortgage applications data.
This gives us a timely, weekly snapshot of the health, the sensitivity of the U.S. housing market. That's a critical indicator given where interest rates are and what consumers are doing.
So until 2:00 p.m. ET, we're basically in limbo. The market's macro direction is just frozen solid, forcing everyone's focus onto the individual corporate battles. Yeah, it's easy to get lost in the big macro picture, the headwinds, the paralysis from this data vacuum. But the real fireworks this morning, they're happening on the corporate battlefield. It proves that even deep fear can't completely stop deal making and competitive warfare. So let's pivot from that macro fear to some micro excitement. Let's focus on the names really driving the pre-market volatility.
All right, the corporate front is extremely dynamic this morning. It tells a story of disruption, strategic pivots, all sorts of things. Starting with the notable gainers, we've got Confluent, CFLT. It's trading higher based on a Reuters report that the data streaming platform is exploring a potential sale. In this kind of market, M&A speculation is just a tremendously potent catalyst. It often drives stocks to a significant premium, especially if the target company is seen as essential to this growing AI and data infrastructure. So traders are watching very closely for any confirmation of a real suitor. That could lead to another big jump. We're also seeing positive momentum for PayPal Holdings, PYPL. This is tied to their unveiling of PayPal Ads Manager. Now, this is a key strategic pivot, and it looks like the market is rewarding it quite heavily. They're moving beyond just pure transaction fees.
Yeah.
They're enabling merchants who use PayPal's payment systems to become their own retail media networks.
Okay, help us unpack that concept a bit. Why is becoming a retail media network such a potentially high-margin pivot for a company like PayPal?
Well, it's brilliant, really, because it leverages their greatest asset, that first-party, real-time transaction data. So instead of just taking a small cut of a payment, they're now helping merchants use customer data anonymized, of course, to offer highly targeted advertising, right at the point of purchase or maybe right after. This is high-margin revenue because the underlying tech, the infrastructure, it's already built. They're essentially selling sophisticated data services and targeted ad space, which carries much higher profitability than just processing a standard transaction. It strategically diversifies their business away from just payments, and it increases the value of their core service offering. Pretty smart move.
And we probably shouldn't ignore the rebound candidates either. After some steep drops on Tuesday, maybe exaggerated drops, we're seeing Ford, F, and Seagate Technology, STX, showing small gains. That feels like the market's early morning litmus test, doesn't it? Was Tuesday selling just an emotional overreaction, part of the general profit-taking vibe? Or was it the start of a genuine shift away from some of these cyclical names? Guess we'll find out later today. But the real competitive drama, the one that tells us something about eroding pricing power, that seems to be unfolding in the credit reporting space. This doesn't look like just a slight price adjustment. It feels like a full-blown price war kicked off by Equifax.
Oh yeah, this is a direct competitive assault. It looks aimed squarely at shattering a long-established market oligopoly. Equifax, EFX, was up, 2.6% after hours? That's because they announced a significant reduction in reports, say up to 20% in some areas, in the prices they charge lenders for mortgage credit scores. This is an aggressive, calculated move, clearly designed to grab market share and basically force their competitors' hands. And the immediate, almost devastating consequence of that move, it's perfectly illustrated by the reaction in Fair Isaac Corp FICO shares. They were down 2.2% after hours. FICO is, or has been, the dominant market leader. And this aggressive price cut by a major competitor directly threatens that dominant position and, crucially, their historically sky-high profit margins. FICO has enjoyed exceptional pricing power for a long time in this space. Investors now clearly fear this is going to trigger a full-blown destructive price war, eroding profits across the whole industry, maybe for years. Big implications there.
Okay, shifting to the downside, we have some classic examples of stocks seeing really extreme volatility because they failed to meet the market's newly raised bar for performance.
Yeah, Penguin Solutions, PENG, is kind of the poster child for the market's brutality right now. The stock plunged at a dramatic 20% after hours. It was due to that classic, unforgiving double miss. They didn't just miss quarterly revenue estimates showing weakness right now, but they also issued a weak forward-looking forecast for their fiscal year 2026. This just demonstrates the market's total intolerance at the moment. If you fail to deliver growth now and you fail to promise growth for the future, the punishment is instant and severe, no messing around. And then you have the sheer speculation machine that is Trilogy Metals, TMQ. This stock was Tuesday's absolute sensation, right? Skyrocketing an astonishing 211%. That surge was fueled by news that a government investment fund, apparently linked to a prominent Trump donor, had taken a big stake. That, combined with getting key permit approvals for its huge Alaska mineral project. Given the sheer size of that spike, the stock more than tripled in a single day. Extreme volatility is absolutely guaranteed to continue today. The market's digesting the news. Speculators might try to chase it. Early investors are probably looking to cash out some serious profits. It's one of those moments where fundamentals just take a backseat to pure momentum and news flow. Wild ride.
And finally, the ongoing saga of Tesla. TSLA. Stock fell 4.5% on Tuesday, and the focus remains squarely on their margin strategy, doesn't it? They recently announced those lower-priced versions of the Model 3 and Y trying to stimulate demand. But the persistent concern, the delicate balance, remains. Were those price cuts aggressive enough to actually spur significant new demand, or were they just aggressive enough to squeeze their already tight profit margins without really achieving the volume boost they wanted? The market seems to be treating Tesla's margin strategy like a classic can't-win situation right now, hence the selling pressure. All these micro moves, the huge gains built on tangible deals, the brutal losses for missed guidance, these strategic pivots like PayPal, they all seem to lead us to one crucial realization about the dominant market theme. That initial euphoric phase, the broad, almost indiscriminate thematic AI buying where any stock just mentioning AI saw a lift, that really appears to be ending. The market seems to have grown up a bit.
That is absolutely the definitive new operating environment. That initial, maybe somewhat irrational enthusiasm is being forcefully replaced by a much more discerning approach, a fundamentally driven approach. The market has clearly moved on from rewarding just promises. It's now demanding tangible, quantifiable results, demonstrable revenue streams. And you see this best, I think, in the contrast between, say, advanced micro devices, AMD, and a company like Penguin Solutions, P&G. AMD's monumental surge up 23% in 2 days, adding more on Tuesday that was driven by a concrete, tangible, multi-billion-dollar supply agreement with OpenAI. The market immediately translated that deal into billions in guaranteed future revenue. That is the new standard. The market is now rewarding quantifiable success, specific contracts, clear revenue implications. You saw that Jefferies' $300 price target upgrade. That wasn't based on some vague theme. It was based on a clear, executable path to real revenue.
And the inverse is the punishment we saw with PM.
Absolutely. That brutal 20% collapse of PN combined with the broad semiconductor sell-off on Tuesday, a classic sell the news reaction, right? Where investors cash out after the initial hype set. It just proves the market is moving past the hype phase, past vague exposure. It's no longer willing to just bid up related stocks indiscriminately without supporting financials. There's a profound capital shift happening. Money seems to be moving away from the application layers or companies that just mention AI exposure. It's now relentlessly focused on the core infrastructure providers, the chip designers, the data companies, the ones that can actually prove sustainable, profitable growth. Investors are demanding proof of execution now.
And this maturation, this demand for proof, it really sets the stage perfectly for the crucial Q3 earnings season, which kicks off in earnest this week. This is going to be the ultimate test, isn't it? Testing corporate resilience against this backdrop of macro fear and now this new higher bar set by AI execution.
Yeah, overall expectations seem, well, constructive but cautious, which actually creates opportunity. Analysts are projecting about 7.9% year-over-year earnings growth for the S&P 500 overall. If that happens, it would actually mark the 9th consecutive positive quarter, which is pretty impressive, frankly. A sign of corporate health and adaptation despite the macro environment. What's perhaps most bullish, though, is that Bloomberg Intelligence finding. Over 22% of S&P 500 companies have issued positive pre-announcements. That's the highest proportion in the year. It suggests management teams are feeling confident, and maybe some potential upside surprises are brewing, particularly in sectors where the cost of capital isn't the biggest factor.
Okay, so let's pinpoint the bellwether reports, the ones that will set the immediate tone for the market starting tomorrow. Who do we really need to watch?
Two critical ones land Thursday before the opening bell. First up, PepsiCo, PEP. Now, this isn't just a food and beverage stock. It's a crucial barometer of consumer health, both here in the U.S. and internationally. Consensus EPS is looking for $2.26. The market will be focused intently on two key things. First, organic volume growth. Is underlying unit demand still holding up, or consumers starting to trade down to cheaper options? Second, their ability to maintain pricing power in this inflationary environment without killing off too much volume. And of course, their management's guidance on forward demand trends will be absolutely paramount for predicting the resilience of the U.S. consumer. Second, we get Delta Airlines, DAL. This will be the first major airline to report this quarter. Consensus EPS there is $1.33. This gives us the first really deep structural look into how third-quarter travel demand actually held up. Key metrics will be the pace of recovery in that high-margin corporate travel, which always lags leisure, the impact of rising fuel costs on their margins, load factors, and critically, their capacity plans for the vital holiday season coming up.
Airlines are just such a direct proxy for business confidence and consumer discretionary spending. Big tells there.
Right. So beyond just the headline EPS numbers, the themes investors will be digging into during these reports are pretty clear and interconnected. It's the tangible financial impact of AI. Is it actually showing up on the bottom line yet? the continued resilience of the U.S. consumer facing all these macro fears, and how things like tariffs and supply chain stability are hitting profit margins. Hashtag analyst synthesis and forward outlook.
So to kind of synthesize the day's strategy, you really have to approach this market recognizing the precarious balance we're in right now, those modest futures gains this morning. They shouldn't lure anyone into complacency. The optimal strategy today, I think, has to be one of patience, strict reactivity, establishing large new positions right before that 2.00 p.m. ET FOMC release carries significant and really binary event risk. The market is just so tightly coiled, so focused on that one release to fill this data vacuum.
Okay, so for you listening, needing to be ready at 2.01 p.m. ET to gauge the market's instantaneous reaction, what are the two immediate real-time indicators you absolutely must monitor to avoid misinterpreting the move? Number one, the U.S. dollar index, DXY. Number two, the 10-year Treasury yield. If you see a rapid drop in both the dollar and the yield at the same time, that signals a definitive dovish red by the market. That provides the necessary tailwind for both growth risk assets and those systemic hedges like gold. Conversely, if you see the opposite, a spike in the dollar and yields rising, that signals a powerful hawkish interpretation. That demands an immediate defensive posture, prioritizing capital preservation over chasing growth.
And this brings us right back full circle to maybe the most critical macro signal of the morning, the one that serves as this constant background reminder. It's the unabated historic strength in gold holding firmly above $4,000. That strength, along with similar moves we're seeing in other alternative assets, it serves as a really clear, necessary reminder. A reminder that a strategic hedge against systemic risk, whether that risk is geopolitical instability or maybe long-term U.S. fiscal policy failure, remains absolutely prudent. Even as this AI theme continues its powerful run, albeit an increasingly discerning run now, those profound fears about fiscal and geopolitical instability, they haven't just vanished. Not at all.
That's the perfect thought to leave things on today. The market is absolutely in a holding pattern, kind of paralyzed, waiting for the Federal Reserve to fill this massive data vacuum left by the government shutdown. The afternoon is going to provide that necessary signal. It will decide whether the discerning AI bull, focused on corporate earnings, or the macro instability bear, focused on systemic risk, takes full control of the session. Thank you so much for joining us for this deep dive into the pre-open market. We look forward to diving in with you again next time.